Greetings and a warm welcome to this week's edition of 401k Real Talk. This is Fred Barstein, contributing editor at wealthmanagement.com's RPA, Omnichannel, and CEO at Trow, TPSU, and 401k TV. I review all of this week's stories and select the most important and interesting ones, providing open, honest, and candid discussion you will not get anywhere else. So let's get real. First story, Empower announced that they will be providing access to private market investments through their managed accounts in partnership with various firms like Neuberger Berman and Apollo. Investments include private equity, private credit, and real estate. The announcement follows a similar move by State Street to create a target date with Apollo. The private markets industry is betting that the Trump administration will be more accommodating, though concerns about liquidity, transparency, and cost persist, prompting one skeptical advisor to quip, "Just because you could doesn't mean you should." Next story, a recent Callan study with larger plans indicates little interest in alternative investments and target dates, with an overwhelming percentage not offering them or not considering them, citing concerns about daily valuation. Hedge funds were the least popular, followed closely by private equity, with real estate the most popular. Next story, a startup initially funded by legendary investor Bill Ackman is aiming to allow investors to use leverage to boost returns in their 401k and IRA accounts. Basic Capital is offering 4-to-1 leverage, which could result in big returns if they earn more than 6.25% interest rates, allowing DC participants to join the private credit boom. Obviously, there are concerns if investments do not perform well, but Basic Capital and a slew of VC firms are betting that they can, especially since DC participants are long-term investors. Basic Capital is also enabling plan sponsors to offset their match obligations. Next story, though there have been consistent growth of record-keeper revenue over the last decade, a McKinsey report predicts that the industry is at a tipping point, with the focus shifting from accumulation to decumulation. As such, providers are moving from product-centric to participant-centric services like IRA rollovers and wealth crossover services, as plan fees continue to decline with costs rising. Total revenues generated from the DC system, including investment products and record keeping, grew from $28 billion to $39 billion between 2013 and 2023. Over the same period, the DC system created $45 billion in new revenue from retail wealth management. IRAs generated $4.5 billion, while wealth sales were $7 billion in 2023 alone, presumably more profitable than record keeping, devaluing providers that cannot cross-sell as their margins decline, likely to bring more to the market. All of which has providers scrambling to capture more rollovers and cross-sell more wealth services themselves or in partnership with advisors, as convergence and the war for participants between advisors and providers heats up. Next story. Forfeiture lawsuits are the latest hot trend in ERISA litigation. The deluge of ERISA lawsuits triggers a number of different reactions, with naysayers frustrated or dismissive. Matthew Eichmann details why these emotional reactions are a disservice to plan sponsors and fiduciaries and mask an opportunity for retirement plan advisors to demonstrate an educated perspective to help their clients take steps to achieve greater protection. Finally, the epitome of convergence of wealth and retirement at the workplace is IRA rollovers. Yet most record keepers and retirement plan advisors fail to capitalize on this opportunity, starting each year with an $800 billion deficit. A group of third parties are trying to help advisors and record keepers stem the tide, but as significant are the opportunities, so are the challenges. Read my recent wealthmanagement.com column about how the race to capture rollovers may determine the winners and losers among RPAs and record keepers. Last but not least, the recent LinkedIn poll asked about the most harmful things plan sponsors do wrong. Overwhelmingly, not understanding their fiduciary duties at 60% was most popular, followed by not understanding fees, not conducting independent due diligence, and not monitoring investments. So those were the most important stories from the past week. I listed a few others I thought were worth reading, covering DC plans are retaining assets to gain bargaining power. Cowen's annual survey reveals big shifts in plan sponsor priorities. Cigna is hit with yet another forfeiture lawsuit. Joe DeNoyer sees market volatility as a teachable moment, and McKinsey on the future of advice. Please let me know if I missed anything or if you'd like to comment. Otherwise, I look forward to speaking to you next week on 401k Real Talk.